Welcome to the presentation on lease accounting. So, why are we discussing leases in the chapter on non-current liabilities? The basic idea is this, that when you lease equipment as a company, you are going to make payments to the entity from which you lease. So these payments that you make in the future are essentially an obligation. And what we are going to see in this reading or this segment is that there are two kinds of leases, operating leases and financial leases, and both require payments. And essentially, while one is a on-balance sheet kind of lease, the other is a off-balance sheet lease. But again, in both cases, there is a future obligation. So let's get into the specifics now. A lease is a contract between the lessor, who's the owner of the asset, and another party seeking the use of the asset. And this other party is called the lessee. So to just highlight that and to make sure you get this terminology straight, the lessor is the owner of the leasing asset and the lessee is the user of the asset. And essentially, through the lease, which is a contract, the owner grants the right of use of the asset to the user, and the user then makes periodic payments to the owner. What are the advantages of an operating lease? And later on we'll also talk about financial leases, but let's say that the basic kind of lease is an operating lease. An operating lease basically presents a relatively less costly means of financing. In a lease, we don't need to pay for the whole equipment upfront. All we are doing is making periodic lease payments. Thus, the lessee can conserve cash. Reduced risk of obsolescence. So at the end of the lease, the asset can be returned to the lessor. So essentially, if you want to use a piece of equipment for 3 years and you are not sure whether the equipment will be obsolete or not after 3 years, the benefit of leasing is that after 3 years, you are just giving the equipment back to the lessor. So it's not your worry as the lessee about whether the equipment is obsolete, whether anybody will buy it, what the value will be, and so on. So that's another advantage to the lessee. So keep in mind that all these points are from the perspective of lessee. So less restrictive provisions, lease agreements can be negotiated to better suit the circumstances of each party. And lease financing represents what's often referred to as off-balance sheet financing, which improves leverage ratios compared to borrowing the funds to purchase the assets. So when you borrow funds, your debt goes up, but when you are leasing, then essentially you do not, or when you have an operating lease, then you do not show any debt on your balance sheet, and hence the leverage ratios look better. Now, as I mentioned earlier, there are two kinds of leases from an accounting perspective: finance lease versus operating lease. Or actually, it would be more appropriate to say that there are two ways to account for a lease. One way of accounting would be referred to as finance, and the other operating. So in a finance lease, essentially the finance lease is the purchase of some asset by the buyer that is directly financed by the seller. So effectively, what is happening in a finance lease is that the lessee is effectively buying the asset from the lessor. So when the lessee is using the asset, he then shows that asset on his balance sheet, and the asset comes off the balance sheet of the lessor. An operating lease, which is essentially what we were referring to on the previous slide, is an agreement allowing the lessee to use some asset for a period of time So essentially this is a rental agreement. Now, as you can imagine, from a lessee perspective, he will always prefer an operating lease because of all the advantages that I showed you on the earlier slide. But accounting rules, both US GAAP and IFRS, present some guidelines based on which companies are supposed to categorize a lease either as finance or operating lease. So a lease must be classified by a lessee as a finance lease, also called capital lease, if any one of these criteria are met. Number one is ownership transfer. So let's say we have a 3-year lease agreement, and at the end of this lease agreement the asset is transferred from the lessor to the lessee, then this must be classified as a finance lease. If there is a bargain purchase option, so say we have a $5 million machine, and at the end of 3 years the machine can be bought by the lessee for 100,000, so that would be a bargain purchase option. Lease term 25% or more of useful life. So if a machine has a useful life of 5 years and the lessee is using it say for 4 years, then again this would be classified as a finance lease. And finally, if the present value of all the lease payments is 90% or more of fair value of leased asset, then this must be classified as a finance lease. So any one of these 4 conditions, if any one of these conditions holds, then according to US GAAP the lease should be classified as a finance lease. Now, what does IFRS say? IFRS is more subjective, and IFRS says that you classify based on the economic substance of the transaction. But essentially, from your exam perspective, I think these 4 bullet points are quite meaningful, and hence I'd encourage you to remember these. So now let's talk about the reporting by the lessee. In an operating lease, there is no entry at the inception of the lease. This means that there is no asset created, no liability created. Essentially, for every year we show a rent expense equal to the lease payment, and this expense is shown in the income statement, and this would be one of our operating expenses. So any expenses that you pay or your lease payment is essentially an operating expense showing up in your income statement. So a lease payment will reduce your operating income or your EBIT. With a finance lease, at inception, the present value of future lease payments is recognized as an asset and as a liability on the balance sheet. So for example, if you lease an asset and the present value of all the payments that you are making is say 3,800, then you create an asset worth 3,800 and a liability worth 3,800 on your balance sheet. Then the asset is depreciated over the life of the asset, and the interest payment is recognized in the income statement over the term of the lease. And the interest expense, as always, is equal to the lease liability at the beginning of the period times the relevant interest rate for this lease. Let us understand this through an example. Say you lease a machine, so you are the lessee, you lease a machine for 4 years and pay 1,000 at the start of every year. The relevant interest rate is 10%. And assume straight line depreciation for the asset. What are the accounting entries? Assuming this is a finance lease. So actually with most leases, the payment is made at the beginning of every period. So let's just do a quick timeline and calculate the present value. So we are leasing this for 4 years. So 0, 1, 2, 3, 4 periods. And what's the cash flow? The payments that you are making, one is the first payment of 1,000 happens at the beginning of year 1, which is times 0. Then again 1,000 over here, 1000 and 1000. So you are making your 4 payments at the beginning of each year. So you need to calculate the present value. The present value you can calculate, so this is going back to your quant knowledge. You can put your calculator in begin mode, make n equal to 4, payment equal to 1000, your FV is 0, the interest rate is 10%, and you compute PV and you should get 3487 approximately. So let's say your beginning value is 3, so present value 3487. Actually I am rounding up over here, and throughout these calculations I'm just going to use the nearest whole number. So there might be slight rounding issues, but you will get the point. So the beginning leasehold value for time, so the way I'm going to show this now is we are going to have this asset for 4 years and we are going to fill this table out. So year 0, what's the book value at the end of year 0, which is now? We are going to record a lease liability. The book value, so this part is the treatment from a asset perspective, and this part is the treatment from the liability and the relevant expense. So the present value at time 0, which is where we start, is 3487. So at the end of period 0, which is right at the beginning, the book value of the asset is 3487. So this is the easy part. What do we do on the liability? So on the liability side, the initial value of the liability is 3487, but right up front we make a lease payment of 1000 because it's at time 0. So the lease payment that we make is 1000, and since this payment is made, it immediately reduces the present value of the liability. So the present value of the liability before this payment was 3487. After this payment is made, the present value of the liability is 2487. Those of you who are studying from Schwezer will notice that they assume that lease payments are made at the end of the year, which makes the calculation simpler, but it's somewhat unrealistic because leases are generally paid at the start of every period. So this is your entry right up front, lease equal to 2487, because we have made our payment, and book value of the asset is 3487. And then what happens in year 1? So beginning year 1, leasehold value is again 2487. Beginning of year 1 is the same as end of year 0. So 2487 over here. Interest expense is equal to 10% multiplied by the beginning lease value. So 10% of this rounded to the nearest whole number is 249. The lease payment at the beginning of year 1 is 1000. So our lease liability is going to become, now how do we calculate our lease liability? We do 1000 minus 249, and that number is the amount by which we reduce the leasehold value. So 1000 minus 249 will give us 751. 2487 minus 751 gives us 1736. So that's the value of our lease at the end of the value of a lease liability at the end of year 1. And let's just finish the liability side first, and then we'll do the asset side after that. So 1736 then becomes the beginning book value at the beginning of year 2. So 1736, and then the interest expense is 10% of this, which rounded to the nearest whole number is 174. Lease payable as always is 1000, and the lease liability at the end will be 910. And the way we get this 910 is we say this is the beginning lease value, and as with any amortization schedule, we look at the payment of 1000, interest was 174, so 1000 minus 174 represents the amount that will reduce the lease value. So 1736 minus the difference of these two will give us 910. 910 is then the beginning lease value for year 3. The interest expense is 91, and the lease payable again is 1000, and again slight rounding error here, but 1000 minus 91 is the extra amount, or the amount that reduces the lease liability, and that reduces 910 approximately down to 0. So notice that by the end of year 3, which is the beginning of year 4, we have reduced the lease liability down to 0. If we had been making lease payments at the end of the year, then the lease liability would have gone down to 0 at the end of year 4. But leases typically are paid at the beginning of every period. So this is our lease or our liability side. So the entries then on the balance sheet from the lease perspective would be, initial entry would be 3487, but that would immediately be reduced by the payment of 1000, and we would have a lease liability of 2487 up front at the beginning of year 1. End of year 1, the lease liability would come down to 1736. End of year 2, the lease liability would come down to 910, and end of year 3, which is beginning of year 4, the lease liability is 0. From an expense perspective, in year 1 we would have an expense shown in the income statement of 249, interest expense in year 2 of 174, and interest expense in year 3 of 91. In terms of book value, initially the asset is recorded at 3487. Depreciation, assuming we are doing straight line depreciation over 4 years, so every year we will have depreciation equal to 25% of this. We are assuming for simplicity a salvage value of 0. So if every year we have a depreciation of 872, so 872, 872, 872 and 872 depreciation in the 4th year. So these are our depreciation amounts. The book value at the end of every year will be the initial book value minus the depreciation expense. So book value end of year 1 would be 2615, then 1743, 872, and at the end of year 4 we would have book value of 0. So on the balance sheet side, at time 0 we record an asset of 3487. End of year 1 the asset is 2615. End of year 2 the asset is 1743. End of year 3 the asset is 872, and end of year 4 the asset has been depreciated down to 0. On the income statement we'll show a depreciation expense of 872 every year. Now what's the total expense when we have a finance lease? The total expense in year 1 for a finance lease is equal to the interest expense plus the depreciation expense. So in year 1 the total expense is 1121. In year 2 the total expense is 1046. Again, this is the depreciation expense plus the interest expense. In year 3 we have 963, and in year 4 the only expense is the depreciation expense, which is 872. So these are the 4 items that you will see, or these are the expenses that are total expense related to the finance lease that you will see on the income statement over the 4 years. Now how does this compare with operating lease? So had we shown this lease as an operating lease, then what would the expenses be? So had this been an operating lease, then the way we would show this is we would then show the lease expense for every year. So you would have at the beginning of every year we would show the lease expense as the money that is paid. So every year we have a expense of 1,000, and that will simply be a rental expense. So notice that in the early years of the lease, a finance lease will show a higher lease expense because this includes both the interest component plus the depreciation component. So in the initial years, the lease expense shown on a finance lease would be higher than the number that we would arrive at had this lease been categorized as a operating lease. So that's the state in the early stages of a lease. But towards the end of a lease, as you see here, these numbers are less than 1,000, and that is because towards the end of the lease, the part that is left is the depreciation expense, and even here the interest expense is there, but it's a very small number because our lease value has come down to a small value, so our interest expense is small. Since the interest expense is very small, towards the end of a finance lease, the lease cost or the lease expense for a finance lease is relatively low compared to the operating lease. And hence, if we look at net income or even operating income, so let's just take net income. With net income, the net income for a operating lease will be higher initially because the operating expense is lower, but the net income for a operating lease will be, so let me just say this again. So the net income for an operating lease is going to be high in the early years relative to the finance lease because the operating expense is low, and in the later years the net income assuming an operating lease will be low relative to a finance lease because the operating expense is higher. Now what I want you to do is pause the video here and make sure that you can fill out this table. So the idea is this, and this is a common question on the CFA exam, where you are given two companies, let's say company F and company O. Given any subjectivity in terms of whether to account for leases assuming finance lease versus operating lease, let's say company F uses finance leases whereas company O makes heavy usage of operating leases. So the type of questions that you might get are, so all else equal, the economics of the two firms are exactly the same. The only difference is that from an accounting perspective, this firm is going to use finance leases versus this firm is going to use operating leases. Who is going to have higher assets? So obviously I'll do the first one for you. So clearly the firm with with finance leases will have higher assets relative to the firm with an operating lease. So now pause this here and fill out this table. Alright, so welcome back. Now you need to check whether you got your answers correct. I'm just going to go over some of these, but then the rest should make sense given what we have talked about earlier. Clearly the liabilities for the company showing a finance lease will be higher because initially we record the asset, we figure out the present value and increase both assets and liabilities. Net income I've already talked about in the early years versus the late years. The total net income will be the same. EBIT or operating income will be higher for the company showing for the company that has a finance lease. The way you can think of this is EBIT is earnings before interest and taxes. So the company showing the finance lease is going to show interest expense after the operating income, and that's why the finance lease will have a higher EBIT. This is important. Cash flow from operations will be higher for a company that shows finance lease. Why is this? This is because the lease expense will be shown as an outflow from operations for the company that is showing a operating lease. Since the entire lease expense is shown as an operating lease for this company, therefore the CFO is going to be lower. Remember, the lease is an outflow, so it's a minus number. So a bigger minus number will mean that CFO is lower for the operating lease, and then for the same reason, then the CFF will be shown as higher for the operating lease. And finally, the total cash flow is the same for both companies. Now here again, I want you to fill out this table. So pause the video and fill this out based on everything that you've learned so far, and then check whether you get the correct answers. So here is what you should have gotten. With a finance lease, the current ratio should be lower, and the reason is current ratio, as you've seen before, is current assets divided by current liabilities. And when we increase, so what's happening here is this is a slightly subtle point. When you have a finance lease, the current assets and current liabilities are not directly impacted. So current assets are clearly not impacted, but with current liabilities, they go up because of the current portion of the long-term liabilities. So the lease payments that are due in the upcoming year increase the denominator, which reduces the overall fraction. And the same logic will apply to our working capital. And now, given your past knowledge of ratios such as asset turnover, return on assets, return on equity, all these other ratios should make sense. If they do not, then you need to go back and revise your previous ratios, but make sure that you understand and remember this table very well. Again, the logic behind this is two companies F and O that are similar in all respects. Only difference is that this company uses finance lease to account for its leasing, and this company assumes operating leases. And based on the accounting difference, here is the difference that you can expect in various ratios.